Hey guys, it's Sunmin and welcome back to Your Money Game, the show where we'll get better with saving, spending, and investing. And today it's all about stuff that's affecting your saving, your spending, as well as your investing. Now, if you've been paying attention to the headlines and news, you might have seen that the US Federal Reserve cutting interest rates to nearly zero. Or you might be in a situation where you're looking at your bank account and you're wondering, why are they slashing your interest rates? Why are you going to be earning less? If you're rubbing your head on confusion and worry, let's figure this out together. So that's why I'm here today to talk to you all about the falling interest rates, what's going on with it, what can we do, and how to think about your money in the event there's going to be low interest rates for the next 5 to 10 years. So let's start with the first big question. What on earth is happening with interest rates? Now, for those of us who didn't do economics in school, very simply put, interest rates can be thought of as the cost of money. And on top of that, it is a tool that governments tend to use to control as well as manage growth. So the theory goes, the cheaper money is, it's cheaper for us to borrow and spend, it's cheaper for companies to do the same thing. They borrow, spend and grow, and then eventually the entire economy tends to grow as well. And that brings us to today. And as you can imagine with COVID, countries, companies, people all around the world are hurting. And the US Federal Reserve have dropped rates so low to 0.025 to 0%, and these rates are really in hopes to support and try and boost growth back again. If you look back at the 2008 crisis, they actually took anywhere between 5 to 10 years before they started to raise the rates again. So if the world kind of follows suit, you can imagine again 5 to 10 years of low interest rates. But then you might be asking a very reasonable question. What on earth does US Federal Reserve interest rates have to do with us? Here in Singapore, here in Malaysia, what's going on? Why does this connect? And it's not because it's cool and trendy, it's mostly about trade. Now again, to put it very simply, when interest rates drop, the value of the currency tends to drop as well. And this actually affects the imports as well as exports of countries. And as you can imagine, international trade is so important to all countries around the world. What's going to happen is that with dropping interest rates from one country, the imbalance begins. And countries do not want there to be any imbalance when it comes to trade. So that's why most countries tend to follow suit. So enough of the economics lessons, let's talk about what is the impact on us as regular people. The first major con is that with all these falling interest rates, if you've been relying too much on savings accounts or very ultra safe type of products like bonds, maybe even term deposits, what's going to happen over the long term is inflation will actually erode the value of that money. One of the few silver linings in this situation is that with the falling interest rates impacting your savings account, it tends to spur people to think about, oh my gosh, what else can I do? And this is where we can go through some of the pros that we encounter in a low interest rate environment. So as I mentioned, with lower interest rates, money is cheaper. So people and businesses who are in a position to be buyers, this is a really great time to again get loans that are cheaper and invest in whether it's a property or whether it's a business or some kind of venture that you have. Also for investors, usually with lower interest rates, what you tend to see is the stock market tending to benefit from it. The one thing that isn't affected by interest rates is your ability to hit that like button as well as the subscribe button so that the gods of YouTube will be happy. So with a very quick overview of pros and cons out of the way, let's dive into the details. What can you really do to adapt to this situation and take advantage of it? The first point is, have you thought about your major debt? With lower interest rates, the first thing to really think about is if you have a home loan, it is a great time to rethink of whether or not you can refinance it. And from all the research I've done, people can save a very substantial amount in the long run. The next is credit card debt. And if you happen to be in a position where you're holding on to that, it might be a great idea for you to really consider looking at a personal loan in order to pay off that debt in a much cheaper way. And again, from what I've seen, the interest rates for personal loans between last year and this year, there's a huge difference and it's much cheaper now to get it. The next big thing to consider is, are you allocating your money in a smarter way? That's a very useful rule of thumb in thinking about how do you allocate your money. And there's 3 buckets. The first bucket is, think of it as savings that you are going to be using on a regular basis. So this is money that you need that's going in and out whether from your salary to pay off your bills to fund your lifestyle. And money like that tends to be put in the bucket that's really safe, it's very easy to use, and this usually is done by putting it in just a regular savings account. The second bucket is money that you tend to need in the short towards medium term, anytime between 1 to 3 years. What you need at this point is really certainty that the money won't suddenly completely disappear, but at the same time, you want there to be some bit of growth as well. The last bucket are investments that you're very comfortable putting it in for the medium towards much longer term. Ideally, it can be a bucket where you just put stuff in there and you forget about it literally to the day that you want to retire. So the ratio to allocate to those three buckets is really individual and it really depends on your situation. But the more you're able to allocate towards that last bucket, planning for the long term, it really allows you to think about taking a little bit more risk, being a little bit more comfortable to explore different type of options. Products in the last bucket tend to be a little bit more volatile, but over a long period, they are proven to give you returns that are much higher than what you can get from savings accounts as well as maybe bonds. The next big thing to think about is, should you reevaluate your current savings products? It might be a really great idea to start thinking about a high yield or high interest savings account. The problem is, in this current environment, even those type of products have been slashed so badly that it's very difficult for you to earn a reasonably good rate in an easy way. Another really interesting alternative that's become much more accessible to consumers now is what you call a money market fund. An example of that is a product that's been introduced by one of those robo-advisors, Stashaway, which is called Stashaway Simple. And in Singapore, it's an advertised rate of 1.9%, and in Malaysia, it's about 2.4%. So because of the relative safety, slightly higher interest rates, it might be suitable for you to park your money, especially in the second bucket, in products such as this. The final big question to think about is, should you be re-looking at your current risk appetite? Now, this might require you to take a step out of your comfort zone, but this is a really good time to start thinking about it because it's almost a guarantee that if you rely on ultra safe products, your money is not really going to grow and it might even stagnate and erode over time. But I'm not just going to point a finger and say take that risk. I've got a few thoughts that you might want to consider in your current position. So one of the major problems that we see in Singapore and Malaysia is the fact that we rely overly much on savings products for the long term in your retirement. So let me walk you through a calculator on what it looks like if you rely on overly safe products and get hit by inflation.
What's up guys? As you can see, we're in this site called Calculator Soup. It's an online calculator site. It's quite interesting. And what we're going to look through is the investment inflation calculator and seeing how does inflation impact the value of your money in the long run. So let's just start with a very simple set of numbers. So assuming you have the investment amount of 20,000 and you're starting with, you're saving for 20 years, you're earning a 2% interest rate, and I'm being generous here, assuming that you're earning a very basic savings rate. Annually, it compounds, meaning the value that you're invested in does not get taken out, you're just letting it roll year on year. You're contributing $1,000 on a monthly basis, and you factor in an inflation rate of 2% on a yearly basis as well. So if you run the numbers, what you're seeing here, let's start with this number. Your future value in the end of 20 years is that you're going to be seeing this number, 323,000 plus. But if you adjust it for the inflation, you're going to be seeing about 218,000 plus. So let's mess around with the numbers and see what happens when you begin to earn a little bit more in terms of your interest rates. So instead of 2%, which is again a very safe savings rate, you're getting a bit more adventurous and maybe you invest in a product like REITs. Let's say you get an interest rate of 5% on an annual basis. If you run the numbers, you can see the numbers already have shifted from 200 plus to almost 300 plus thousand in terms of an inflation adjusted rate in the future. Again, if you're taking a little bit more of a higher risk and you're investing in stocks, the expected returns of stocks as an asset class over the long term is anywhere between 7 to 10+% depending on who you talk to. So let's just take the low end, 7%. already from 200,000 plus to 393,000. It's almost a doubling of your money. And this is again with a 20-year horizon. Now, very quickly, I'm just gonna change it to 30 years. So let's assume you're, again, maybe in your 20s, somewhere in your 30s, and you've still got a long road ahead in terms of working, earning, and investing. Let's start this at 2%. So for 30 years at a 2% rate, you end up with about nearly 300,000, 291,000 in the end of 30 years. 5%, suddenly it nearly doubles from 291. Okay, fine, my math is bad. So from 291, it goes up to 490 plus. And if you change the rate again to 7%, that blows up to about 700 plus thousand. Now again, the contrast between you starting younger and you starting later is huge. And on top of that, the contrast between you investing at a 2% rate versus something like stocks over the long term giving you 7%, you're seeing a massive difference in your ability to build wealth over the long run. So if you're somebody in your 20s and you've got a long road ahead of you, taking small steps and just gradually investing in, you're gonna see a really great outcome in the long run. And I know the 2% in annual inflation rate, some might call it high, some might call it even low, I don't know. I think it's a reasonable rate to kind of project. So I hope this was interesting. Let's get back to the video.
The next consideration is that if you're already in your 30s and 40s, odds are you are in some of the best earning years of your life. If you do not take the chance to invest now in a bit more aggressive way, the older you get as an employee, it actually becomes a higher and higher risk of you taking some kind of shock towards your income. And as you can see in the current COVID situation, shocks like that do happen. The next consideration is that volatility is not the same thing as risk. Most of us tend to be afraid or feel a little bit uncomfortable with volatility, which is the swings of prices. When products like savings and bonds, they are guaranteed to give you a low return, but it's extremely stable and you can see a very nice, smooth rise over the long term. So because of the fear of volatility, and you might not have thought into the long term that much, that's why it's so important to think about that third bucket that you have, which is money that you're really going to park away for 10, 20, 30 years into the future. The longer the term that you can consider, the more comfortable you should feel with the fact that prices will always be volatile over the short term, but over the long run, you're going to see the rewards in terms of higher returns. The final consideration is that it's really cool to just ease into it. Nobody's expecting you to go from savings account to buying individual stocks like that. But very simply put, going from safe to medium risk, you might be looking at products like REITs. And again, if you want to take a little bit more adventure, if you want to move towards stocks, you don't even have to pick individual stocks. You can just buy ETFs and buy entire countries. So yes, it's depressing when it comes to your savings account right now, but this is a fantastic opportunity for you to take charge, change the way you play your money game, and really improve your financial future. If you have any questions or thoughts, please feel free to comment below and I'll get to it. And I really hope that you got value out of this. And if you did, I would really appreciate you hitting that like, subscribe, as well as that bell button, because all those things really help me grow. And until next Sunday, keep playing your own game.